Hey, Bowtie Nation. Joseph Hogue here with Let's Talk Money. Welcome to another Beer Money Sunday. Actually had a gym day today, so it's coffee for me, but whatever you're drinking out there in the nation, you go ahead and have at it. See a lot of a lot of our Bowtie Nation regulars here in the chat. Thank you for being here Sundays. I love doing these live streams. Gets a little bit more face to face with you out there in the community, answer some questions and talk about a topic each week. And this week we got a great topic for you, very timely, kind of a stock market news a video for you, really all around the House passage of that foreign stocks delisting notice, and we're going to talk about that. Talk about whether you should be investing in Chinese stocks, if there's any danger there, and maybe even some opportunities. I know a lot of people are out there saying, hey, why do I need Chinese stocks? That whole geopolitical risk, the government risk with that, but you can't ignore some of these companies. Alibaba, 25% annualized return over the last 5 years, right? 25% a year over the last 5 years, and I think it's still undervalued. This is the Amazon of China, and got a lot of good fundamentals behind it. Nio up 11-fold this year, so you definitely cannot ignore some of these Chinese plays. And I'm going to kind of explain what was behind that. That House bill is probably going to be passed into law, what that means, and what you should do with your Chinese stocks. See everybody coming in on the chat from Belgium, Columbus, Ohio. I saw Albany, New York, and Pennsylvania earlier. Welcome. Thank you for being here again. It just, it amazes me every weekend. I love connecting with all you out there in the, in the 2 p.m. messes with my workout time. Yeah, I gotta, when it falls on Sundays, I gotta do it either really early or really late, and I can't enjoy my Sunday beer. But we're gonna get to it. So we're gonna get to it here. Just a reminder, the Webull 4-stock promotion, it has been extended through December 14th, I guess. Just talked to Webull this week, and they said they were going to extend it. A lot of people asking about it. If you know Webull, the platform, stock trading platform, I've been using it for a little under a year now. Love it for that trading kind of idea. They were have a stock simulator app on the on the platform that's really fun to use. You basically just kind of simulate your trades. They give you $1 million paper money. You follow your trades before you invest your own money. So I love using that feature. And in the past, they've done like 2 free stocks when you open an account and when you fund it. Now they're doing 4 free stocks. So you get your first 2 just for opening an account. Don't even have to deposit any money. But then when you make that first $100 deposit, they give you 2 more stocks. So, tends to be $8, $10 stocks. Not a ton, but you deposit $100, you get $40 in stock. That's a pretty damn good return. Supports this channel, so I appreciate it, and it is a good platform to use. So look for that link there in the chat. I've pinned it on the chat, or I'll pin it in the first comment below as well. So we're going to get to it here. We're going to do a little bit of recap real quick. Last week's videos, next week's videos coming up like we usually do. Do that China stocks theme, and then we'll get to your questions and answers after that. Again, thank you everybody for being here. I see a lot of good questions already coming up in the chat. Nio, JD.com, Alibaba, a lot of those stocks that could have very good futures. Alibaba, like I said, Alibaba is the Amazon of China, and I feel like we're still, where we were at with Amazon 10 years ago with Alibaba, as far as the valuations, as far as the market reach and the reach for that company. The Singles Day, which is kind of their big Prime Day or whatever for Alibaba, that keeps setting records every single year as far as internet traffic and all that. So yeah, I just don't think you can ignore a lot of these great companies that could be the future of really investing. So last week it had a couple really fun videos for me. Friday, the life lessons video, if you don't remember, out on the community page there on the channel. Great way to just kind of connect, and kind of a social media site there on YouTube. But on the community tab a few weeks ago, I asked what was your favorite life lessons or your biggest life lesson, and got huge responses. Got something like 95, 96 responses to those. And so what I did Friday was really cool. I went on the Cameo app, which you can you can talk to a bunch of celebrities to read messages off for you, basically. And I got 7 celebrities, and these were really cool. These were people like Tom Arnold, Chuck Norris was there, Gilbert Gottfried, Randy Couture, to read these life lessons back on a video, as well as offer a lot of their own life lessons as well. It was really interesting, some of the life lessons these celebrities offered. So go back, check out that video. That was on Friday. That was yesterday or Friday, because yeah, and especially the life lesson offered by Tom Arnold, comedian Tom Arnold, fellow Iowa native, a really amazing story about, how he set a goal to make his father laugh when he was younger. Single parent, raised those 3 kids, Tom being one of them, and it was really an amazing story. Check that out and check out that video. Next week, just real quick before we get to the theme this week, next week we've got a big week for videos. 3 videos tomorrow. Monday, we're going to be covering the SPACs. Big topic. I know everybody's been asking me to do a video on those special purpose acquisition companies. So I finally took the time, dug in a little bit deeper, and really looked at these, and was kind of surprised what I found. There's some very nice, legitimate companies there. Some of them, the Bill Ackman's SPAC is a good one. Highlighted couple others, highlighted 3 SPACs that I'm watching, but also the risks there, because there are some major risks in these SPAC companies. Okay, they don't call them blank check companies for nothing. Okay, so definitely watch that video tomorrow if you've ever thought about investing in these SPACs, these special purpose acquisition companies, because there's definitely some risks and some things you need to know before you invest. And then Wednesday and Friday, we're going to continue with our 2021 investing theme, that series that we're going. A really neat step-by-step strategy to start investing and to turn it into a cash flow and an income there on Wednesday, sharing that. And then Friday, one of my favorite stocks, one of my favorite videos to do each year, a dividend stocks for 2021. So I put together a list of the 5 dividend stocks I'm putting in my own portfolio for 2021. So be watching for that on Friday. So I want to get to the topic today because it is timely. Everybody is talking about this last week. It is going to passage. So basically what happened is this bill was passed in the House. It had already passed in the Senate. This is the U.S. Senate. It's called the Holding Foreign Companies Accountable Act, right? And basically what it says is that it threatens to delist any foreign companies. And when I say foreign, that's pronounced Chinese, right? Because that's really what the target of this bill was. Threatens to delist any of those Chinese companies if they fail to comply with the U.S. Public Accounting Oversight Board's audits, okay? And that's for 3 consecutive years. So now what this is the Public Accounting Oversight Board, right? The PCAOB, okay? It's a 5-member board here in the United States appointed by the SEC. And it oversees all the audits of public companies, right? So any company that with listed shares on the markets has to get a quarterly and an annual audit, right? Just to make sure, an accounting firm has to come in, they check their books, they check what they're reporting to make sure that it's legit and it meets accounting standards, right? Just for that transparency. So they go in and they don't necessarily, this PCAOB that doesn't inspect the companies, it inspects the accounting firms, right? It makes sure that the accounting firms are doing these audits within those standards and that the outcome is transparent. Okay, it was created in 2002 as part of that whole Sarbanes-Oxley after the accounting scandals like Enron and WorldCom. It registers public accounting firms and then sets those as accounting standards, and then it inspects them to make sure that they're following those when they do these audits of public companies. So it's just a very important tool for transparency, for accountability at any company that's going to be listed on the U.S. markets, right? Kind of, it obviously doesn't minimize the risk to zero that there's going to be accounting fraud or fraud at companies, but it's just a much higher level, a much higher standard of accounting and auditing, right, and transparency. Well, what happens is the Chinese authorities have long resisted this, right? They don't want the PCAOB coming in, or foreign regulators coming in, inspecting their accounting firms and their companies, right? It's they put it behind the trade secrets idea. They put it behind a national sovereignty idea. Who knows why, really? So securities regulators have really been fighting that idea of they don't want foreign companies coming in, inspecting their accounting firms, inspecting their companies. And, I mean, part of it is they just don't want loss of trade secrets, right? Which, I don't want to get political about it or anything, but come on, China has benefited from theft of property secrets, for decades, right? They've been able to say that companies wanting to do business in China have to have they can't have a majority stake in the company. They have to set up partnerships, and then obviously the companies have been able to benefit from that intellectual property that's brought into the country, and brought in from that. But it's a sovereign nation. They can set their own rules and everything, and yeah, they don't want they don't want their trade secrets shared, just like we didn't want ours. Okay, so that's really what we're looking at, right? Is this Holding Foreign Companies Accountable Act was passed in the House. It's going to be signed by the president. He's already said he would sign it and supports it. So basically, what we're talking about here is after 3 years, okay, because these if you don't pass that. If the accounting firm doesn't pass that that PCAOB inspection for 3 consecutive years, then you can delist the stocks, right? So it's got to be 3 years. So one, it's going to be 3 years before anything happens on this anyway. But there's also a lot of reasons why Chinese stocks might not necessarily be in trouble. Okay, a couple of reasons. First is that this only affects those Chinese accounting firms, right? So basically, if those Chinese accounting firms don't let the PCAOB or other foreign regulators come in and inspect those accounting firms, then after 3 years, then any stock that uses those accounting firms to audit their financial statements, then they can be delisted. But especially a lot of the large Chinese stocks, we're talking Nio, I think maybe even Alibaba, they're using U.S. accounting firms to audit their financials anyway, already. Okay, so this has no effect on them. Okay, so that's one. So if you're investing in a Chinese stock that uses a U.S. accounting firm to audit its financials, audit those financial statements and reports, there's nothing to worry about there. Now, another part of that's probably largely symbolic at this point. It gives the firms 3 years for compliance, and there's probably likely going to be additional years after that, if nothing else. We've already seen some give on this by the Chinese government on the issue, and it's likely going to allow a little bit more oversight into its accounting firms, right? It's probably going to, rather than lose that funding source from the U.S. markets, it's going to allow some kind of foreign, auditing or foreign oversight into these accounting firms, right? Now, what I wouldn't be betting on is some of the a little bit more closely held funds or closely held companies in China, right? Now, I don't want to get into a discussion, or I don't want to see any chats about how the Chinese government is communist and they control all the companies. No, come on. Let's be honest here. Let's not give in to all the propaganda and shit we hear. China is no more communist right now than maybe Brazil or even a lot of countries in Europe, right? Okay, maybe the government has more influence on companies, but it's not controlling these companies. But for the most part, it's not stealing their data and all that kind of stuff. That's just kind of propaganda and bullshit, really. But what I would be worried about is those state, a little bit more state-controlled companies where the state does have a high ownership and control of that company. And here I'm talking about things like I'm talking about things like the insurance companies, the financials, so the banks. I'm talking about the PetroChina, so the energy companies. Obviously, the government is going to hold a majority stake and be state-controlled in those companies. So, I wouldn't necessarily be betting on those, and I never really have. Okay, I have liked China Life Insurance for a period there because it was excellent valuation, and we ended up doing very well on shares of that. But for the longer term, I would be hesitant to invest alongside the government in those kinds of companies. But when you're talking about other companies, Alibaba, Baidu, NetEase, JD.com, the Nio, I don't think you have to worry about any kind of state control, state influence, things like that on these companies. If nothing else, that domestic that domestic influence, that domestic power, being a Chinese company is going to help these companies, right? You know, all countries are protective of their own industries, whether it's explicit or maybe even implicit. And China's no different, right? It helps, through subsidies, through special rates, lending, that kind of thing. It's going to help its own companies, just like every company does. Okay, so that's going to benefit Alibaba, Baidu. That's going to benefit all of those local domestic companies. So long story short, you don't this Holding Foreign Companies Accountable Act, the Chinese stocks delisting, that whole thing, really a non-issue at this point, right? Where it does help you is that it has created a little bit of a buying opportunity. These stocks didn't come down a lot on this news because the market's looking at it and saying, so what? Nothing's really changing right now, and probably not likely to change. But they did come down a little bit, and like I said earlier, a lot of these stocks were already trading at pretty good discounts. What we're looking at here, if you look at a lot of the emerging market funds, a lot of money managers, they're already underweight Asia and underweight China because of the trade war and the geopolitical risks over the last 2 years, right? So not necessarily just this act or this law coming up, but just over those last 2 years, they've really underweighted the country and the stocks from domestic to that country. So what we've seen is, especially over this last year during the coronavirus, is the Chinese market and its stocks have really outperformed U.S. indexes, not just for last year, but for the last 2 years now, really. The economy is arguably in better shape going into 2021. Now, no, I don't fully trust China's reporting on their own coronavirus cases, but even feet on the street reporting of their economy, traffic demand, that kind of thing, or traffic. A lot of the real time data that we get from money managers, from portfolio managers, the economy is set better off. Okay, going into 2021. The stocks are undervalued because all these portfolio managers, they're underweight in the area, so there's not that demand to it. So you get a lot of these great long-term holds that are undervalued right now and have a good chance to go forward in 2021. I think there's a good chance you see that momentum start building. Like I said, the Chinese indexes and the Chinese stocks have outperformed over this last year. And I think you see that momentum keep building into next year and maybe even beyond. Maybe as some of the rhetoric gets toned down a little bit, but just really as portfolio managers start to, come back into Chinese stocks and that kind of thing. Some individual shares that I've been looking at, obviously, I'm a big fan of Alibaba. It's trading right now at about 11 times earnings, which is closer, versus about 20 times last year. So if you just take it on that basis, on a historical PE basis, I mean, it's almost half the value, right? It could potentially double from here just on that 20 times PE multiple, right? But trading for 11 times right now and against a 93 times multiple for Amazon, right? Now, I mean, I'll admit Amazon just, continues to confound value investors, right? Amazon never trades below 50 or 60 times earnings. On the face of it, horribly, tragically or expensive, but the stock keeps on going up. So, I wouldn't necessarily say 93 times multiple is super expensive for Amazon because Bezos just surprises us all forever. But when you compare it with Alibaba, 11 times earnings versus 93 times earnings for Amazon, the model is almost identical. In fact, I would say Alibaba basically they just looked at Amazon and they just do what Amazon is doing, right? They just copy that for that market. And it's going to be the largest market in the world. So, I can't see how Alibaba at 11 times earnings is not a great deal. Clearly undervalued company doing 30% sales growth a year and a profit margin of 22%. So definitely one to look at. For its part, Baidu, a little bit different model there, business model, trading at 14 times earnings, down 42% from the April 2019 peak. They've still got the revenue growth, good fundamentals. It's not quite as good as Baba. So, if I was trying to decide between the two, they're not necessarily one for one kind of a decision there, but I like Alibaba a little bit better. Again, other ones you can look at, that JD.com, the Nio has had a huge year here. Maybe getting a little expensive. I'm hesitant to jump into the electric vehicle stocks right now just because of the pandemonium that has been in the share prices lately. But a lot of great stocks there. Again, I would avoid probably some of the more closely state-controlled companies like PetroChina, China Life, the energy, the banking, and the financials there, because those are going to be a little bit closer state-controlled. And as we get closer to this 3-year window where stocks are going to be delisted if they don't meet these PCAOB regulations, these standards, then you could see some weakness in those state-controlled companies like that will probably just delist in the U.S. and then list over in Hong Kong. So that's kind of where we are there. I've seen a lot of great questions here in the chat. I'm going to scroll back up and check this out, and we'll get into our question and answer session. If I don't see your question, again, just ask it in the comments below, and I'll try to get to that. So a lot of questions about Alibaba. I think we've covered that. Again, it's just hard to see Alibaba not being a good investment here at 11 times. I think I was in it in 2012. It was about $95 a share. Held on to it for a couple of years there. And even after that 25% annualized return over the last 5 years, it's still a very cheap company. So CHL, another China company, I believe that's China Life, right? Or China Mobile. The mobile, anything tech, I think is probably a good something to check out there for those Chinese stocks. Just because it's the largest growing economy not the largest growing economy, but one of the largest, certainly the largest large economy. I think India is probably growing a little bit faster, but China is something like $15 trillion and still growing at that 6%. Besides 2020, 2020 still growing at about 6% annual growth, which is amazing for a $15 trillion economy. What else here? See somebody else from Bettendorf, Iowa. Subu, good to see you there. Brazil, wow, just amazing how far people come to tune in to the Bowtie Nation here. Love seeing it. Thank you. What else? What do you think about day trading? Seems like a ticket to losing all your money. It mostly is. I mean, we talk. I'll talk penny stocks on the channel. I'll talk. Not necessarily trading. My shortest investing window is usually about 30 days. Maybe a few weeks if I'm trying to hedge on some market events, on some news, something like that. I rarely, if ever, do any kind of day trading. And because I think it's not to say you can't make money day trading, but I think people have just the wrong impression of it. Okay. This is a profession. It's a profession like a lot of other different types of in the financial market. And if you're not willing and ready to sit at your computer, sit at multiple screens, because you need your charts up, you need your news up, and you need your trading window up, and you need that up market hours plus. Okay, so you need to be at your computer during the market hours, plus another 2 or 3 hours. Another 2 or 3 hours a day, just thinking about the day's trades, doing getting ready for the next day. So if you're not ready to spend 10 hours in front of your computer trading every day, then what makes you think you're going to beat all these other traders out there? Okay, it's kind of a zero-sum game, right? You're competing against other traders, the high frequency traders, all the other investors out there. And so unless you got some crystal ball or whatnot, it's extremely hard to beat those, especially those professional analysts, those professional traders. The bulge bracket banks, J.P. Morgan, Goldman Sachs, they all have their trading floors. So I know everybody says they're an above average trader, above average investor, but you got to think about it rationally. Are you really going to be able to beat those guys on a consistent basis? So I wouldn't be day trading. What else? Oh, wanted to heads up. Happy Sunday from Kelly D. Thank you for that. You actually reminded me. Going to be no live stream next weekend, next Sunday. I believe that's, the whatever 7 days is from now. 13th. No live stream next Sunday. Wednesday is actually my birthday, December 9th. We're going to be going out of town on next Sunday over next weekend to celebrate that. So I'll see you again in 2 weeks, but no live stream next Sunday. Just want to make sure everybody knows on that. What's your take on Michael Burry shorting Tesla? From Alex. Great question. Like a lot of these EV stocks, you can't analyze them on fundamentals. There is nothing in the future of this stock that would justify the price to earnings ratio of Tesla, Nio, all these EV stocks. Honestly, okay. Now that's not saying that they can't go higher. Sentiment. If you're talking anything less than a year time frame, 90% of stock prices is sentiment, is investor sentiment, right? It's investor sentiment around, just whatever the company is saying, as far as, in this case, whatever Elon Musk wants to tweet, right? It's around the company's earnings reports that, and their outlook, right? And how different is it from expectations? So really, trading or investing in anything in under a year time frame, completely sentiment, and you really need to be able to base your price, your stock price, and your valuation estimates on that sentiment, not necessarily on a price to earnings basis, right? Now, longer term, it's a lot of it is that price to earnings, the earnings growth of the company, and that's where a lot of the short sellers are looking at Tesla and saying, and just scratching their heads, right? You got Michael Burry. So if you don't remember, that's the who's that? The Big Short, right? With the Big Short movie they had not too long ago about the financial crisis, and he made literally billions in shorting a lot of those mortgages, but now he's shorting Tesla, right? And it's kind of ironic, because the week that he really announced that he's shorting Tesla, Jim Chanos, which is another huge short seller, a big market player, announced that he was cutting his short position in Tesla. Right, he's a longtime Tesla short. There, probably lost money over time, I imagine. I don't know, how he was positioning in and out of that. But yeah, just last 2 weeks, Jim Chanos said he was cutting his short position in Tesla because Elon Musk, I don't know if he's the devil or what, but he always seems to be able to drive that share price higher despite anything else, despite even bad news. So maybe a little bit of black magic going on there. I don't know, but I don't know that I would bet against Tesla, right? I sure as hell wouldn't be investing in it, because I'm a fundamentals, I'm a value investor kind of guy. So I want to invest in something that looks good on a valuation right now, and I can hold for many years. What I see in Tesla is, okay, it's got an amazing first movers advantage in electric vehicles, and that means a lot. That's worth a lot. But eventually these other car companies, they're going to catch up. Okay, they're all spending billions of dollars to catch up in electric vehicles, in the batteries, and everything else. And it's a learning curve, so it's going to take them a little bit, but they're going to catch up, right? And at that point, some of that mystique, some of that first mover's advantage really wears off for Tesla. And that price to earnings ratio, which for Tesla is, I don't know where it's at right now. It's in the hundreds, right? Versus those traditional car makers, Ford, GM, Volkswagen, all those are down around 10 or 12 price to earnings multiples. So that has to start equalizing, right? So, I don't know if that's a long-term thing where, just over time, the price multiple for Tesla comes down, or if it's an all-at-once thing. But either way, it's bad news for investors, right? Because it could mean years of pretty much dead money in that investment. Even as those earnings keep going up for Tesla, if that price multiple keeps coming down, so right now, if investors are willing to pay, for example, 100 times price to earnings on $1 per share, right? Well, okay, even if that earnings per share comes up to $2 or $3 or $4, if that price multiple comes down to 50, comes down to 25, which would still be well over these traditional car makers, then your stock price goes nowhere, right? Because investors just aren't willing to pay those super high multiples anymore. So that's really what I'm looking at in Tesla and why I don't invest. Okay, now, okay, obviously, a lot of you have made money out there. That's great. I love that. I love seeing that you can make money on it. And I think you can over the short term, but it's all sentiment. It's all sentiment where it goes over the short term. Over the long term, what I'm looking at, 3 to 5 year trading horizon, it's a little less, obvious. Yeah, so the SPACs seem nuts. So Jay says the SPACs seem nuts. It's weird. It's a blank check company, and it is literally that. You got to be willing to pay these investors. Just give them a blank check for those shares of that blank check company, because you don't know what they're going to acquire yet. Basically, and I'm going to do all this tomorrow in that video, so watch for that. But yeah, it's some of them worked out historically though, and I shared this in the video. Historically, if you look at, I think it's been since over the last 5 years, since 2015, maybe before, these blank check companies have produced a total return of 10%. Okay, and that's against a 203% total return for the S&P 500. Okay, so don't think, there's nothing new in these blank check companies. They've been around for decades. It's just a backdoor method to get a company into the market. Right, and it's just this year that they've really blown up with things like DraftKings, things like Nikola, things like that. Those some of the other electric vehicle companies. It's just this year that the idea, the theme has really blown up. So don't think automatically you're going to jump into these SPAC companies and make multiples on your money, because it just hasn't happened in the past, and that's just because it has happened this year doesn't mean it's going to happen this year. Okay, Dimitar from Bulgaria, love that, from Bulgaria, wants to know which sector do you think is going to be on fire next after the EV cools off. Now, and I'm going to be the first to admit, folks, it's a little bit of truth here, hashtag truth. I'm not the best person to ask about hot stocks, okay, because again, like I said, I'm a traditional fundamentals investor, right? So a lot of these hot sectors, EV, a lot of the fintech stuff, DraftKings, things like that, they start off so expensive, so overvalued that I'm not going to take a chance on it. Yeah, I might lose out on the next hot stock, but I make a good 15-20% annualized return on my portfolio, and I'm extremely happy with that, right? That's only slightly above the venture capital returns I was making when I was working in that industry, right? Angel investors, venture capitals make right around 25 to 30% a year on that part of their portfolio. But I'm really happy with 15 to 20%. And so asking what's going to be the next hot sector, a hot industry theme after EV. I mean, you got to look in small caps. You got to look in the small cap themes. So I would be looking at obviously IoT, so Internet of Things, and we did a video a couple of weeks ago about that. You're looking at the hardware and then the software apps after that to be investing in those. You're looking at robotics. You're looking at artificial intelligence. So something like a Palantir. I wouldn't necessarily say a Palantir because it's just exploded since its IPO, and the valuation might not quite be there yet. But I would look to, some of those companies that aren't necessarily EV, that have competitors that haven't blown up yet, right? So maybe something like a Snowflake. See who its smaller competitors are. Really, what you're doing is you're looking in these small cap companies, so companies with a market cap of under $1 billion, right? And $1 billion doesn't seem like a small company, but it is in today's market. But you're looking for companies with a market cap under $1 billion, and you're looking in these long-term themes that are going to have a lot of money in behind them. So IoT, Internet of Things, the 5G. We did 5G a couple weeks ago as well. The robotics, AI, things like that, right? And it's not necessarily saying that these are going to be the next hot thing all in one year like EV has been. right? But it's going to be, it's going to be that 3 to 5 year time frame where you're going to be able to book that 20 to 30% annualized return on a portfolio around these stocks. Okay. So definitely one's in there, and again, the reason why you're looking at such small companies, these small cap or even micro cap stocks, is because if you're looking for a 20 or a 30 times multiple on your money, you're not going to do it with a $30 billion company, right? So for example, I think Palantir is like $60 billion market cap. I think it opened at like 30 billion on the IPO. It's now at about $60 billion. So just do the math here. If you want even a 20 times multiple on your money here with that company, it has to become a $1.2 trillion company. Okay, so it's 20 times 60 billion, which isn't impossible. Obviously, there's a lot of companies that are there. I think Apple is at 2 trillion now, but it's not going to happen overnight. It's not going to happen as quickly as it's doubled there. So you'll want to look at those smaller companies, $1 billion. That can grow to a 30 billion or a $50 billion company. Look from those. What else? I see helping homeless keep asking for Huya. I really don't know. I haven't analyzed Huya, so I'm gonna have to check that out. Yeah, but if you're asking over and over again in the in the chat, just ask once. Be patient. I'll get to it. But on that one, I'm going to have to check out the fundamentals on that. What else? Numbers are excellent. Yeah. Alibaba, it continues to amaze me why that stock trades at that valuation at like 11 times earnings. And obviously it's because, a lot of investors just won't own foreign stocks, period. They won't own Chinese stocks even beyond that. A lot of investors are, obviously wary or hesitant. Even if they'll consider Chinese companies, they're still wary or hesitant about Chinese companies given the trade wars and all that stuff. But if you want to look at fundamentals and earnings growth, sales growth, Alibaba continues to surprise and will do that, in the future, I think. I hope Nio tanks because of this. Yeah, I'm not moving the market. Even with my 288,000 subscribers, Robert, I'm not going to move the markets. So not enough people watch these videos. I wish they did, but they don't. Not enough to move the markets there. What else do we have? 25% dip is not. I don't know what that means. I saw there we go. So PMO did a super chat. I appreciate that again. A $5 super chat there. What are your thoughts on crowdfunding investments like Fundrise? Great question. Fundrise is a real estate investing site, crowdfunding site. Basically, it's kind of like a REIT, except a privately listed REIT, right? And I'm on Fundrise. I use Fundrise, have for about a year now. I think I like it as a form of getting my real estate exposure, but being able to maybe analyze the properties a little bit closer than I would a REIT. Basically, you've got crowdfunding real estate sites like Fundrise, like Streetwise is another one that I'm on, and your portfolios of properties in those are generally going to be maybe 30 properties or so. So it's a lot easier to follow what they're investing in, keep track of that, rather than maybe if you're in a Simon Property Group, right, the mall owner, which owns hundreds of malls all across the United States, all and some international, I think. So it's much easier to analyze these smaller crowdfunding REIT portfolios than these massive REITs. So I like them. The fees are a little high on some of them. That's why I pretty much stick with those two platforms, the Fundrise and the Streetwise that I've used. So yeah, you definitely want to watch the fees on them. Some of the other ones, and I don't want to name names, Realty Mogul, but you got to check how they're set up too, because investors, and in that one, maybe they've changed it. I checked a few years ago, so I haven't checked it lately. But the way the fund is set up, you're investing in this distinct company, this distinct fund, not necessarily in the properties. So it's a little bit more, risk there, management risk rather than just the real estate risk. What to buy tomorrow? That's a great question, Mike. I'd say look at the videos. Whether you're a dividend investor or a growth investor, that's really what you got to look at, and not necessarily just tomorrow. Um, what else here? Where to buy 10 cent? 10 cent. Hugo asks where to buy 10 cent. Great question. Actually, it is traded on the OTC, so the pink sheets, I think it is. It's a Chinese company, and mobile games maker, right? And actually a very good company. They've got some great games, and a good stock. But yeah, you have to be on a platform that allows you to buy those pink sheet and those OTC companies, right? Which a lot of platforms don't. I think E-Trade does. I think probably Webull allows that pink sheet trade, and you'll have to check. But yeah, I know like M1 Finance doesn't. I don't think Robinhood won't let you trade those. So you have to be on a specific platform to be able to get access to those stocks. I have to grab a beer. We'll wait for you, Nick. What else? I see somebody asking for Momo. Sorry, I haven't covered that. So what is that? Momo Inc. Yeah, I haven't covered that. I'll have to look into the fundamentals on that one and get back to you because I don't know that one. So much from Nio to the moon. Okay, we've got some Cyrillic name here, and my Russian is so old that I will not even attempt to spell his name. But thank you for the super chat. 200 rubles, I guess. Nyabet, I don't know. Sorry. Yeah, it's been a long time for my Russian. What about U.S. economy overall updates? Everybody talks about the big buzzword right now about the U.S. economy is pent up demand, right? Everybody thinks, okay, people have been holding off their vacations. They've been holding off their spending or whatever. Right now, 2021 is going to be a miraculous, marvelous year for the economy. I just don't see it. I'm a contrarian sometimes. This is one of those times. I don't see 10 million people additional. Okay, so we had, whatever we had unemployed in February, before the whole coronavirus pandemic. I think it was 3.4 million, I want to say. Got an additional 10 million people right now unemployed. Okay, so that's about 14 million. The unemployment rate did come down to 6.7% yesterday in November's numbers, but it way under came in under expectations, right? 274,000 jobs added, which was under like 600,000 expected, right? And we're really seeing the effects of that third wave of the epidemic or the pandemic coming through. So 13 million people unemployed, right? 7%, much higher when you actually count the unemployment numbers correctly. When you include those people that aren't making as much as they should be making and aren't working the hours, you've got you've got people coming off the unemployment rolls, the March coronavirus benefits rolling off here in December. You've got, I think it's last numbers I saw, something like 15% of the mortgages and the renters in the nation were at least a month or 3 months behind, not being evicted because of the moratorium. But what happens in January when that comes off, right? So I just don't see this huge pent up demand in the economy, right? So I'm not nearly as optimistic on the economy over the next year as I think a lot of people are, and especially when you pair that with stock valuations, right? Okay, so what I've been talking about over the last couple of weeks, over the last month, is we might get a decent economy next year. We might get that 20% rebound in earnings like analysts are expecting. And we might get to back where, things were back in February of this year. As far as on an earnings level, we might, but that's kind of 50-50. But then when you look at these stock valuations, right? 21 times on a forward basis for the S&P 500. All-time high, you got to go back to 2000 to get a PE as high as that, right? So, I'm not willing to bet, one, that the economy is going to do really well, and two, that stocks aren't expensive right now. I I can put on my covered calls. I can stay, 20, 30% in cash for 6 months, right? I'm not losing out on anything because, inflation is nothing. And I think in 6 months, you get a better opportunity to get in a lot of these good long-term names, right? Now, I wouldn't be totally in cash. I've still got my money invested. A lot of the long-term stocks that I do hold, I've got covered calls on them. So basically, I'll sell a call option at a strike price higher than the current price. So I still get some of that upside benefit, but I do protect my downside just a little bit. So, I think when you're hearing all the buzzwords, the themes of the day, like pent-up demand and all this stuff that people are talking about in the markets, I think you have to kind of put on your contrarian hat just a little bit and say, well, just a minute, I mean, how are 13 million people unemployed? How do they have pent-up demand, right? How do the 20 million people that are at risk of being evicted or losing their mortgage or getting foreclosed on in January, February, how are they going to have pent-up demand? Okay, and how's that going to affect the real estate market? And then, what are the knock-on effects of that? So I just think there's too many unintended consequences, that we're looking at next year that is not being priced into the market, and that's really what you have to do with anytime you're investing. You have to just think, okay, what's the market assuming right now? What's everybody saying right now? And how might it be wrong? Okay, it doesn't necessarily mean that it's going to be wrong all the time and you're going to be right, but that's where your money's going to be made, right? Because if everybody's planning on this one story, this one theme over the next year, then that's where the market is pricing it right now, right? And right now, with the entire market saying we're going to have all this pent up demand and the economy is going to be great and all that, that's why we have 21 times forward earnings, right? Stock prices are 21 times the earnings that analysts expect over the next year. So that's the market story, and if you believe in it, then that's the problem. If you believe in that market story, you're basically at fair value right now. You are at all-time highs for PE, and you're basically flat, right? But if you're wrong, and then those earnings come down a little bit, the PE multiple comes down a little bit, then that's when you need to be hedged. You need to be a little bit in cash to take advantage of those lower prices. So great question there. Yeah, 13 million is the official number for unemployed. Unofficial is at least 20 million plus. And if you look at these different levels of unemployment between, just the people looking for work, a big part of it and why the unemployment rate keeps coming down is because, and I used to do this for the state of Iowa when I was an economist there, is the way they measure that. They just say, okay, you know what? Are you looking for work? And if people say they aren't looking for work, if they've been unemployed for so long and they're sick and tired of it, they say, no, I'm not looking for work. Okay, you're not unemployed. You're just not in the labor force. Okay. They don't count those people. And what's been happening is, over the last 4 months, is a lot of people have been dropping out of the labor force. They've just been saying, you know what, I'm tired of it. I'm not looking for work anymore. So they don't count them. So, if you actually count those people that could be working, the unemployment rate is much higher and it's much more people. What else? Stocks are very expensive. Yes, they are. Mike Nichols, thanks for that super chat. $5. I appreciate that again. Is JPM? Linda has a question. Is JPM the best bank stock to own? Great question. If you've been watching the channel for the last couple of weeks, maybe months, I really like the financials going into 2021. And really, when you're looking at bank stocks, you got to understand there's two different types of bank stocks, right? One is JP Morgan, Goldman Sachs, things like that, banks like that are a lot of their business is capital markets, right? They got the investment banking, they've got the trading fees, they've got the bond trading windows, right? So they do well when the market does well, right? And then they also do well, with the lending and the economy as well, but not quite as much as, say, a community bank. Or a commercial bank, excuse me. The commercial banks like your Wells Fargo, like your Huntington Bank, like your Bank of America is kind of both of them. But like, your banks that mostly focus on lending, right? Mortgages, small business lending, that kind of thing. Those are really two completely different business models within the banks, right? And so what we've seen over the last year, or even the last couple of years, is these capital market banks like JP Morgan, like Goldman Sachs, done really well because the stock market's done well, okay? Not necessarily quite as tied to lending and rates and the economy. Well, what happens though when maybe lending comes back, maybe the economy comes back a little bit stronger, then you're going to have the commercial banks outperform, right? So that's really why I've started positioning a little bit more towards those commercial banks. Okay, now JP Morgan, Diamond is a genius. Okay, one of those rare geniuses, genius CEOs. JP Morgan will do well, I think. I think they'll always do well. It's a very well-run bank, so I don't think you can go wrong investing in JP Morgan. But like I said, I'm shifting a little bit more towards those commercial banks. I don't want to get too deep into it because I've done a couple videos on the financials over the last week. But if you look at it, a lot of the reason why these commercial banks have done so poorly, have underperformed over the last year. It's like those second worst sector next to energy is those the financials, and a lot of that's commercial banks. And it's because as the economy starts to come down, then the banks they take money out of their earnings and they put it into a separate account, a cash account on their balance sheet called loan loss provisions, right? And this cash account is meant to cover the loan defaults. So if the economy stumbles even more small businesses start defaulting on their loans, then they can take this cash reserves account that they built up and put it towards that, so they don't quite suffer the earnings losses that they did. But what happens, obviously, is if while they're taking that money out of their income statement and out of their earnings, then those earnings just plummet. Okay. So actually looking at Wells Fargo last couple of days here, their earnings went from something like $4.60 down to 37 cents. $4 over the 2019 period, something like 37 cents so far this year, right? And it's been because they're still making those sales, they're still making the loans, and especially those mortgages. Mortgages are red hot right now with the interest rates as low as they are. But they're taking so much money out of that to put into this loan loss cash reserves account that their earnings are nothing, right? So now what happens, and I know I'm getting really deep into the economic weeds here, but what happens if we do, get another small business stimulus plan? What happens if the economy does come back at least a little bit so there aren't that many commercial loan defaults, right? All the loan defaults that these banks are estimating, anticipating, what happens when those don't show up? Well, the bank goes back and it checks and it says, okay, well, maybe we don't need this $10 billion in cash reserves in this loan loss account. Then they move that back onto the earnings statement. They say, we were wrong, put it back in earnings, and earnings just explode higher, right? So that's why I think that the commercial banks could do better than anybody's thinking about in 2021. Another reason, obviously, long-term rates are coming up. And banks, those lending banks, those commercial banks, they make their money on that rate spread, right? The Federal Reserve has said they're not doing anything with short-term rates over the next 2 or 3 years. They're not going to move them higher. They're just going to let them stay there at the bottom. Well, if long-term rates go up, you got a better spread for the banks to make money, and I think that's that's something that's not really priced into the market right now. So again, I'm looking at those commercial banks, the banks with more lending than their capital market exposure. So again, Wells Fargo, Huntington Bank, the regional banks, smaller regional banks are going to be the ones that have that commercial lending exposure. What else? Tesla will fly. Robert, thanks for that. Thank you for the happy birthday. Again, it's Wednesday, but at this point, anybody here with me in their 40s, mid 40s, birthdays are just, it's Wednesday, right? It'll be nice to get out of the city on the weekend. What else? Joe Biden sent from China. Come on, man. No, Joe Biden is not a puppet sent from China. Okay, let's get away from the propaganda, the bullshit that we hear on channels, and let's think about this realistically. Okay, the guy's been in government for like 47 years. Okay, where was China at 47 years ago? Come on. Jumia. Owis's boss wants to know about Jumia. That's interesting. I haven't seen that. The Amazon of Africa. I'll have to look that up because that would be interesting. The problem is, and I used to be a huge believer in emerging markets. Okay, in fact, one of my first analyst speaking gigs was at Bloomberg conference in 2011. went to New York and was on a Bloomberg panel on Bloomberg TV about emerging market stocks and specifically stocks here in Latin America. But the problem is, developing markets, emerging markets, a lot of them, they never emerge. Okay. And a lot of it is just the a cultural, limitation on productivity. People work to live instead of live to work. It's a key difference in emerging markets in maybe Asia, where they have that more formalized culture, where a little bit more success is something that's prized. Whereas here in Latin America, maybe in Africa to an extent, then work isn't necessarily something that you have to strive for, right? So productivity never really catches up with where it should be. And I'm not saying this to be, to talk little of a lot of these countries. I live in Colombia, have for 7 years now. But just from what I've seen is, the productivity, the fact that there's so much more corruption, there's so much more, there's the rules aren't formalized because it's more of a social structure kind of thinking, and it's more of an informal economy. Then corruption is there, and these emerging countries never quite emerge. So that's always something I'm worried about when I'm investing in stocks headquartered, domiciled in Latin America and Africa, in some of these other countries that are emerging. But yeah, that's interesting. I'll have to check that out. Moderna was much cheaper 6 months ago. Yeah. Disney. Jason wants to know about Disney, and again, that's I think Disney is one of the few media companies, if you can call it a media company, and I guess most of it is media, that I think that I like right now. I think the stock price has been held back because of the theme parks, so maybe it's a little bit more value than some of the other pure play media companies. But it is still doing pretty well. Still, basically flat. Flat for the year, which I think for a grower like Disney is a good deal. Okay, and basically what you've got is the the trade-off between their leisure and hospitality assets, like the theme parks, that kind of thing, and the studio, versus the streaming that is really changing the world. I mean, Disney Plus is probably one of the few streaming platforms that I've considered buying, or getting a subscription to. And we've had it for a little bit, but yeah, Disney Plus is way undervalued right now and holding the stock up. And I think once you get the theme parks coming back and the studio coming back, Disney, the Marvel movies that we've been waiting for more than a year to watch, Black Widow, and I can't wait anymore. But once we get the studio business and the theme park business back, then Disney is definitely one that I would be looking at. All right, we are going on a year here, or a year. It feels like a year sometimes. Been going on a year and an hour here. Thank you everyone for being here. If I didn't get to your question, please ask it in the comments below when this video gets published. Thank you for being here again. I love this back and forth, kind of a little bit more personal, a little bit more face-to-face than we get in the videos. Watch those videos. Check out the videos next week. Like I said, tomorrow, SPAC stocks, special purpose acquisition companies. Hot topic right now. I know a lot of people are interested in those. Definitely check those out because I'm going to be sharing three to be watching. So until then I will see you in next week's videos.